All right, welcome everyone. We're back. Broker Podcast.
It's good to be back.
How are you, Mitchell?
I'm good.
That's good.
I think it's been quite a while,
Yeah.
and what have we been doing?
We've been busy writing loans, many a loan. Busy times out there at the moment, so it's the wild, wild west.
That it is.
But yeah, so we're back with a shortened version of our podcast. We've decided a bit more easily digested version. We want to give you what you want to know and send you
get out.
Yeah.
What are we talking about?
So today we are talking about fixed versus variable rates. So obviously,
and why are we talking about fixed versus
well,
variable?
I think there's been a big emphasis on or focus on this in light of recent times. Obviously, interest rates are trending upwards, with the RBA also coming on board saying that they're increasing the cash rate. That's put a spotlight on interest rates, and yeah, I think that's a daily question I'm getting at the moment is, should I be fixing or should I stay variable?
Yeah, I think there's also a common theme in the media at the moment. There's a lot of scare. I don't know. I wouldn't say scare tactics, but
Yeah, I think it would
something along those lines, where the media is basically portraying that
Anything to get a story.
going out the window, and if you're not fixing now, you're going to be in deep trouble.
It's Armageddon.
But we obviously just wanted to come on here and discuss what the pros and cons are of fixed versus variable.
Yeah.
And basically give you maybe just a small rundown of a couple of examples of what the differences are between your fixed and your variable in terms of repayments.
Yeah. I think, first and foremost, if we establish, I guess, currently, as of today, the average variable rates at the moment are sitting about 3.2, 3.3 kind of mark. That has increased quite dramatically in the last, I would say, 3 to 6 months.
Yep.
We were sitting at low twos originally, back in that time. And the average 2-year fixed rate is about 4.4%, which blows my mind. 6 to 12 months ago, we were under 2%. There were 1.89% fixed rates going out. So it is a big dramatic increase. But I guess, did you want to break down what kind of impact that has on the average loan amount?
Yeah, I think it's all well and good to talk about what the interest rates are, but in terms of repayments and how that actually looks for the average person, on a $500,000 home loan, your weekly repayments are roughly about $500 a week. On average, and then that's for a variable rate for that 3.23%. Again, on average in Australia at the moment. For fixed rates for that, again on average for that 4.39% average fixed rate at the moment, you're looking at $577 a week on a $500,000 home loan.
So that's a $76 increase.
Yeah, so the difference is it's about $76 a week difference between those two rates. So if you're in the situation at the moment where you're on a variable rate and you're looking at fixing, you're probably going to be on a lower variable rate at the moment on average than what the fixed rate that you're looking at is going to be.
100%.
So you have to expect that your payments are going to go up, but are they going to go up by a lot? Not really. It's a necessary evil, obviously, if you do want to fix, because you've got that certainty of repayments.
Stability.
It's going to be locked in for whatever period you decide.
But
on a similar note, if you were looking at that's a $500,000 home loan, but for, let's say, someone has a $600,000 home loan, the difference in weekly repayments is about $92 a week between those two rates, the fixed and the variable. And then for a mortgage of $700,000, you're looking at close to $107 a week difference. So again, depending on what your home loan balance is at the moment, if you are looking to refinance and fix or move away from your existing lender, you may find that your repayments aren't necessarily going to get cheaper, but they might just be, slightly increased, but at the added benefit of locking in with, security around your repayments.
Yeah, and that leads us into, I guess, the pros and cons of each. But obviously, if you are looking at fixing, your main kind of pro is that stability. So okay, that is exactly my repayment for however many years. So the fixed term can be 1 to 5 years generally, and you have that certainty of repayment there, versus obviously a variable rate which fluctuates according to many factors, economical factors, and obviously that's trending upwards at the moment. So they're the kind of trade-offs that we're looking at, or the main trade-offs, I would say, between the two. What I say to my customers a lot is at the moment especially, it comes down to what your specific needs are, but also how you anticipate the economy is going to act, and how quickly those variable rates are going to climb. So, the question is, how quickly are they going to climb, and
where are they going to stop?
Where are they going to stop? Exactly right. So that's crystal ball stuff. Neither you or I or anyone can tell you what's going to happen there. But yeah, again, it always comes down to the specific customer's needs. If you're wanting to, look for a short term kind of cheaper interest rate, in the short term, you feel like that variable rate is going to kind of stay quite low, or just lower than the fixed rate that you're looking at, probably better to go with the fixed the variables option, as long as you're comfortable with some increases and fluctuating rates. Whereas opposed to a fixed option, first home buyers, people like that who just really want that stability.
Yeah, you want certainty of repayments. You want to know that you're only going to make the average or minimum repayment required.
Yep.
Because there obviously are limitations with how many extra payments that you can make on most fixed rates.
Yes.
So you just want to you want to lock it in. You set and forget.
Yep.
The same repayment's going to come out on a weekly, fortnightly, monthly basis.
Yep.
So first home buyers, or someone who just likes that security around what repayments are coming out.
Yeah. Actually, that's a really good point too. Is the other big scenario that I would highly recommend a variable option would be is if you are going to make some extra payments, some decent extra payments. So whilst a fixed rate option limits your extra payments generally at about 10 grand per year, a variable option generally has unlimited extra payments. So if you're planning to really smash this thing out, I would be jumping on that variable option regardless of the rate itself. And that comes again down to your specific needs. Whereas, if you just want to kind of chip away at it, make a couple $100 extra each week, fixed is probably the better option at the moment. So
there is one other scenario that has come up often in the last couple of months, and that is splitting your loan and doing half a portion of your loan variable and a portion fixed. Doesn't have to be split down the middle. It can be set up however you like.
Yep.
But for people who, they're worried about what the future entails over the next couple of years with rates potentially increasing further.
Yep.
Splitting your loan to have, a portion of it set as a fixed rate.
Mm-hmm.
You don't have to worry about that portion. Again, it's locked in. It's doing its thing.
Yep.
But then your other portion, you've got, a bit of flexibility. You can make extra payments to that. But if rates do increase,
Yep.
then you're not smashed with, an increase on your whole mortgage. It's just going to be that variable portion.
You're diversified.
Yeah.
Yep.
And that's something that I think we've both seen with a few people
Very
recently.
common.
That's
Yep.
quite a common occurrence.
Yep.
You do have to set up obviously 2 facilities.
Yep.
To do that. So there is a minor added cost with, setting up 2.
Yeah, usually a setup fee or something like that, a couple $100.
Yeah, but the pros of doing that obviously far outweigh the cons.
Yeah. And that way you're getting, like you said, the best of both worlds. You're getting that, especially if you look at, 3/4 of it fixed. Okay, you've locked that in, you've got that certainty of repayments, but you do want the ability to make the extra payments as well, the unlimited extra payments. you can then smash that off the variable portion, and you're kind of covered there in both aspects. So I think they're the most common scenarios that we're coming across at the moment, and that's, I think we've touched on what we needed to touch on there. So take away that information and do as you will. If you have any other questions,
our aim is to touch everyone.
Well, you said it, not me.
If anyone is is looking to potentially, find out about a fixed rate, you maybe want to look elsewhere, look at reducing your whatever rate you're currently on, or just locking in, then let us know, because we can obviously look into the options for you and work out what the best scenario is.
Yeah, exactly. We'll touch you with our expertise. Anyway, we'll leave it there, I think, because it's heading down a dark path. Thanks everyone for watching. We'll be here for the next one. Thanks.